Okay, guys, let's start now with our first baby steps into accounting, into the adult world of accounting. And we've told each other a little while ago in one of the previous videos that all the financial statements and all the IFRS statements and all the IS statements are based on the conceptual framework. So the conceptual framework is the foundation on which all IFRS and IS statements are based on. Therefore, it is extremely important that we know exactly what is stipulated by the conceptual framework, and you have to know this work by heart. Okay, let's see what the conceptual framework is all about. Now, the first thing that it's all about general purpose financial statements. We also told each other that the main financial statements that we're talking about is number one, the statement of financial position, previously known as the balance sheet. So there you know that we're talking about assets, liabilities, and equity. The second statement that is important is the statement of profit or loss and other comprehensive income, or for short, the statement of comprehensive income. Now that in the old terms, the income statement. What do we record in the income statement? Income less expenses equals net profit for the year. The third thing is our statement of changes in equity. In our statement of changes in equity are all the transactions that the entity that we're busy with conducted with the owners of that entity. If it was a company, it would have been with the shareholders. If it's a sole proprietor, all the transactions done with the owner, the business owner of that entity. Now, if you think about a sole proprietor, what type of transactions can be conducted with him? Well, it can be either a capital increase, capital reduction, it can be withdrawals that he makes out of the entity, and then obviously the net profit that was recorded in the statement of profit or loss, that also belongs to them. So that must feed through to the statement of changes in equity. The statement of cash flow, well, that is when I'm actually going to have a look at the movements that took place in the statement of financial position, and that converted into a cash figure. I want to have a look at my business, my trading activities. So the trading activities, the end result of that is all being recorded in the income statement, statement of profit or loss. And I want to translate that into a cash position. So I'm going to convert it into cash so that I can see at the end of the day what the cash flow position of the entity looks like. So what do we want to achieve in the specific study unit? Guys, you are required to understand and discuss the following principles. Listen carefully. You are required to understand and to discuss the following principles. Now, let me tell you how things are working in ACCC. I've told you before that this is the flagship accounting course at Varsity. That means we do require from you very specifically to use that grey stuff that's between your left ear and your right ear, and to start to develop critical thinking skills. So therefore, you will never receive a question, give me a definition of X, Y, Z, or give me the principles involved, or give me the characteristics. Never. I will give you a scenario. Out of that scenario, I will ask you whether I should recognize this as an element in the financial statements. You have to identify out of the scenario, and what am I talking about here? Let's say, for instance, the whole scenario was about an asset and income. Now, you should be able to give me the reasoning behind your conclusion that it's an asset by applying all these things. You will give me the definition of an asset, or you have to give me the recognition criteria, and then you have to apply it. Or whatever I'm going to ask you, I will give you a scenario in the background, and you have, with the specific theoretical knowledge that you have. You have to give me the theory first, and then you have to apply the theory to the scenario that I give you. Okay, so the first thing that you have to know is what is the specific purpose of financial statements? Why do we do that? Why do we bother? I want from you to know what is the underlying assumptions on which financial statements are based on. Then you will be surprised to know that financial statements actually have things that they call fundamental qualitative characteristics, and I want to know what it is. That is not the end of the story. It even has enhancing qualitative characteristics, but you must also be able to, number one, give me the theory, number two, be able to apply that in a practical scenario. Definition of the elements of financial statements. Now, guys, elements is a nice word for assets, liabilities, income, expenses, and equity. So those are all elements of financial statements, and there are a specific definition attached to that, which is set out in the conceptual framework, which you should be able to know by heart, and you must be able to apply that definition criteria when I give you a scenario. Recognition and derecognition criteria. Now, what does that mean? Now, recognition criteria means when can I recognize an element in the financial statements? Derecognition criteria is when do I stop recognizing an element in my financial statements? Now, when I record a transaction, I have to record it at a certain value. So those elements that are appearing in my financial statements are all recorded at a certain value, rand value. Now for that, there are certain measurement bases that I can use. And you must be able to distinguish between all those measurement bases, and you must be able to talk about that, and you must be able to apply that in a practical scenario. Now in your textbook, you will find this chapter 2, which is all about the conceptual framework. So guys, although these slides are relatively in detail, it is not enough. You have to fill in the missing gaps by reading through chapter 2, studying chapter 2 as additional to this slide. So this slide is only a guidance of the stuff that you should know. The detail is all in your textbook in chapter 2. Now, the conceptual framework is aimed at the preparation of general purpose financial reports. It has a specific objective in rendering support to the users of financial statements. Now, who are the users of financial statements? Well, guys like standard setters, auditors, suppliers of services and goods like your creditors. If you want additional loan from the bank is the user. Don't forget our good friend SARS, the receiver of revenue. He is a big user of financial statements. So there are a lot of people. But the potential investors, I want to invest in your company. What do I have? What can I use to tell me something about your company? Only a set of financial statements. So those are all users of financial statements. So that is the purpose of the conceptual framework, to make that financial statements as logical and user-friendly as possible. What is the components of financial statements? Now again, that is what are the financial statements that makes up the whole package deal. Now the first one is a statement of financial position, which is in the old terminology, the balance sheet. Now, the statement of financial position portrays the economic resources of an entity. Just think a little while, what does economic resources mean? Guys, what is an economic resource? In plain, simple English, that's my assets. I use the economic resource in some kind of way. For what purpose? To make money out of it eventually. So I need the resource, I apply the resource in doing something, I get something out of that resource which I can sell on to a third party, out of where I'm going to generate some kind of income. So economic resources is a fancy word for an asset. It says it portrays the economic resources of an entity. It portrays the claims against the resources. Wait, now, what does that mean in plain simple English? Claims means somebody can get something from me against the resource. Now think about that logically. Let's say, for instance, I have entered into a loan agreement with Absa Bank. I have to repay this loan in 12 months' time. It's a short-term loan. I have to repay the loan in 12 months' time. What is that loan for me? That is a commitment, a liability for me. What does the bank have? The bank has a claim against my resources, my cash resources in 12 months' time, when they are going to force me or whether are entitled that I have to repay the loan. So what is going to happen at the stage that I'm going to repay the loan? My cash resources is going to reduce with the amount that I'm going to pay to the claimant against that resource, i.e. the bank. So I'm going to pay the bank an amount of money, they are the claimant in this case, and consequently, my cash resources will reduce. So claims against resources, that's nothing else like liabilities. Number 3, the impact of the transaction and events on the resources. Now, guys, think about it. When we enter into transactions, let's say, for instance, we are a manufacturing environment. We make furniture. We sell that furniture that we are making. And we are going to make, hopefully, at the end of the period, a profit. So income less expenses equals profits. What am I doing with that net profit for the year? I'm going to post that net profit. I'm going to transfer that from our income statement, from a statement of profit and loss, to the equity section of my statement of financial position. Why? Because that profits belong to the owners of the entity. So the impact of that transactions, that will be recorded in my income statement, and it will be reflected in my net profit for the year. And when I transfer my net profit to equity, then it will become part of my statement of financial position. It is also an indication of the liquidity and solvency of an entity. Now, what is liquidity? Liquidity is the ability of the company to meet its short-term commitments. So where do I get that? Guys, I get that from our working capital figures. What is working capital? Current assets less current liabilities. Where do I find current assets and current liabilities? Statement of financial position. So I have to have enough current assets to cover my current liabilities so that I can meet my short-term commitments. And that information is directly out of our statement of financial position. What is solvency of an entity? That is the ability of the entity to exist in the longer term. Now, where am I going to pick that up? Well, guys, a few things are going to tell me that. The one thing that's going to tell me is what is the current financial position of the entity? What is the wealth of that entity? Now, the wealth of the entity equals assets less liabilities. And if I'm going to place a reasonable value on my assets and I'm going to deduct my liabilities from that, I should be able to see whether this company is fit to exist in the future. So that's solvability. Also, I can have a look there and I can say, well, in my solvability, and that actually goes to the next thing, is information is useful in predicting future cash flows and the ability of the entity to raise finance and meet commitments. So if I look at my statement of financial position, I can see how much of my economic resources was funded by the entity's own capital and how much was funded by outside capital. Now, outside capital is typically loans that I've entered into to partially finance my economic resources, my assets. So if I made use in the past of not a lot of outside finance, and I've mainly made use of own finance, i.e. capital equity, to finance my infrastructure, my economic resources, it means that probably there is some room for me to raise further finance if I want to expand from outside sources. So all this kind of information I can get out of my statement of financial position. How am I going to use my statement of financial position to predict future cash flows? Well, once more, if I have made use in the past of too much outside financing sources, it means I will have a huge interest liability that I have to service on an annual basis. Now, that interest liability has a direct impact on my profitability. It's a cash outflow without any returning cash inflows as a result of that interest payment. It is a dead expense. There it goes. I cannot make money with that. It's only an outflow of my cash resources, and I get nothing in return for that. So if that burden is too high, it's going to have a negative impact on my future profitability. If it has a negative impact on my future profitability, it's going to have a negative impact on my future cash flows. And therefore, this company then will suffer in the future. Because it's going to suffer in the future, it's going to have an impact on its liquidity, its ability to meet its short-term obligations, as well as on its solvency, its ability to survive in the longer term. So can you see that everything here talks to each other, and that is the beauty of financial statements. Nothing exists in isolation. Everything's got everything to do with the next thing. There's fully integration between this financial statements, and it tells you a wonderful story if you make the time to read it. Now, our next financial statement is a statement of profit or loss and other comprehensive income. Old terminology, income statement. Now, what do we see there? There we can pick up the financial performance of the entity during the financial period under review. So what is financial performance? Income less expenses. So financial performance will measure or is measured on the profitability figure, the profits that the company has generated during the financial period under review. Now we use historical information to predict future performance and the ability to generate cash flow. How can we do that? Guys, if we had an increase in our profitability over the past 5 years, let's say our earnings are increasing with an average of 10% per annum over the past 5 years, then obviously I can use that 10% and I can say, well, the past has, I've learned out of the past that my profits increased 10% per annum. So therefore I can make a relatively safe assumption that my profits will grow next year with 10% as well. My expenses, if I'm going to put that on a graph, has increased annually, let's say, with 1% under the consumer price index. So I have the consumer price index, that is a general figure that's available, and now past experience has learned that our expense structure, I wish it is possible, but let's say for this instance it is, our cost structure has always grown with 1% less than the CPI. So therefore, if I want to predict the future, then I think it is safe to say that next year we can use that as well. So our expenses next year is going to be 1% less than the CPI index. So you can use certain information based on certain assumptions, and obviously also it's not only assumptions, you make the assumption based on some kind of scientific evidence. Once I have the scientific evidence, I can make the assumption and I can apply that assumption to something that's going to happen in the future. Our statement of cash flow. Now that provides information in the changes in the financial position. So that would be the changes that took place in assets from last year to this year, liabilities from last year to this year, and then also in my profitability, in my income statement. What happened there in my operating activities? So when we're actually going to compile the statement of cash flow, we can say, well, our cash flow position or our cash flow that we generated for the year was in or out of investing activities, in or out of financing activities, in or out of operating activities. So when we're going to come into the second semester, we're going to do cash flow statements, IAS 7, and then you will understand more clearly what we're talking about here. Now, the cash flow statement obviously is where did the company receive these cash resources from and how did he apply? So how did he distribute it, those cash resources? Statement of changes in equity, I've already spoken about that. We said that that is all the transactions conducted with the owners of the entity. If it's a one-man band, sole proprietor, it's with the owner of the sole proprietorship. If it's a company, it's with the shareholders. So things that you will see there is if there was changes in capital or equity, so there was additional capital that he put into the entity or he withdrew some of the capital out of the entity. So that's capital transactions. Dividends is a distribution of profits to the shareholders of a company. But what is distribution to the owners of a sole proprietor? Guys, that is nothing else than withdrawals. And then any other distributions made to the owners. Now, we said to each other in a previous video that we don't want to clutter up financial statements. So in a financial statement, we want to try to keep it as short as possible. We have the description of the line item and we have an amount. But sometimes it's not enough for the user of the financial statement to really understand what this is all about. Now, if that is not enough, then we give him a note or supplementary schedule so that he can now better understand what that line item was all about. Obviously, there's cross-referencing that takes place between that line item and the note that's going to describe that note further. I have to know what the accounting policies was that the company adopted. Why? Guys, if I'm going to compare two companies, similar type of companies with each other, but those similar type of companies apply different accounting policies. Now, it's 100% allowed. There are certain accounting policies that you're allowed to apply. The problem with accounting policies that differs is that it has a direct impact on your profitability. So if I'm going to compare two companies with each other with different accounting policies, I must make some kind of adjustment between those two companies' results to make provision for these different accounting policies that they apply so that I can bring them on the same basis. Because it's only when they are on the same basis that I will be able to compare apples and apples with each other. So therefore, it's very important that the company's accounting policy or entity's accounting policy is clearly set out in the financial statements, in the notes, so that the reader of the financial statement will know when to make an adjustment or what type of adjustment he has to make in order to bring two companies in line with each other so that he can make useful comparisons between the two. Now, in that notes, risks and uncertainties must also be discussed. Now, let's say, for instance, there's a risk, this company or this entity that we're working with has one major client. So income from a major client makes up 50% of the total earnings of this entity. Now, that client, let's say, for instance, has experienced serious financial difficulties in the current financial period, and it is uncertain whether they are going to continue with their relationship or their contract obligations or their contracts or conducting business in the future with our company. We are busy now with the financial statement compilation of our company. Now, although nothing has happened as yet, and we have realized a profit of X amount, nothing can change that. That money has been banked. There is a serious threat that in the next financial period, we will have significant less income coming from this specific client. And therefore, our financial results in the future financial year can be adversely affected, but seriously adversely affected as a result of this financial difficulties of our one major customer. Then, guys, it will be very important that we note that in our financial statements. It is very important that we tell the readers of the financial statements, watch out, maybe next year we will not have this kind of profitability that we've experienced in the past 3 years or whatever. So there's a risk and there's uncertainty which will have a serious impact on the entity. So that must be mentioned in this year's financial statements already, because we've known that when we actually compiled our financial statements for this year. A last thing that has to be mentioned is things like resources and obligations not recognized in the financial statements. Now, what can that be? Let's say, for instance, I am a motor manufacturer and I am giving a guarantee on the engines of the motor cars that I manufacture. I don't have a clue how many of those engines are going to pack up next year, and those owners of those motor vehicles is going to lodge a claim under the warranty against the company. I know at least there will be at least most probably 1 or 2, but there could be 30 or there could be 40 or there could be potentially 4. So I don't know. There's so lot uncertainty surrounding that obligation of me to meet the guarantee. I cannot measure that and I cannot put a value on that. But the fact of the matter is I still have the obligation to honor the guarantee. Then I must just mention that fact by ways of a note in my financial statements so that the reader of the financial statements is well aware of the fact that potentially I can pick up a claim under the warranty. Now, what is the underlying assumptions? And guys, you must know this. If I ask you the underlying assumptions or I give you a scenario, you must be able to identify that this is all about the underlying assumptions in the preparation of financial statements. And there are 2 of them, going concern principle and the accrual basis. So I can give you a scenario of a company that is battling to stay afloat, and then you must be able to identify, it's all about the underlying assumption of going concern. You must be able to talk to me what the definition of that is and then apply that to the scenario. Now, what is the going concern principle? That is the assumption that the entity will continue to operate in the foreseeable future. Now, if this assumption is not valid, then it means I cannot measure my assets at normal values. I must go and measure my assets at liquidation values, and I have to make a provision for liquidation costs. Now, let me give you a simple example. We are still in this COVID rubbish predicament. All of us know people who has either lost their jobs or their businesses as a result of the lockdown measures under COVID-19. We also know of people that maybe haven't closed down as yet, but if there's going to be one further lockdown measure which prohibit them from conducting normal business activities, they will for sure go under because they are all hanging on a thread. Now, can we apply the going concern principle? And for the first time in history, and I'm very old, and it's the first time since I'm alive, and it's got something to do with accounting, that going concern is now a very common thread amongst entities. It used to be the once off here and the once off there. Now it is common. So guys, what will happen now? If we think we don't know if there's a 3rd wave, a 4th wave, what 5th wave, will companies be forced to close down again? And if they are forced to close down again, will they be able to survive? And I think in a lot of instances, the answer is no. They will not be able to survive. Now we cannot compile our financial statements on the going concern principle. We have to use the liquidation basis. Now, what is the liquidation basis? Guys, instead of showing our assets in our books at the current values, which is the historical cost, we cannot do that anymore. We have to use the liquidation values. Now, all of us are human of nature. All of us know that, let's say, for instance, you know somebody who has a super duper wonderful boat that he drives around with on the Vaal Dam or Vaal River or wherever, but it's a beauty of a boat. And it costed a packet of money. And to know that that guy who owns the boat, his business is in serious trouble, and he is sitting in a terrible cash squeeze. What are we doing as people? Hey, did you hear about old John? Old John's got serious financial difficulties. You know, he's got that boat, very nice boat. I'm sure we can pick up a huge bargain there. All this guy wants is a little bit of cash in his pocket. And what do? We fall over our own feet to get to John in order to make him an offer for his boat, which is considerably less than what the actual value of that boat is. And our poor John, he's in a fix. So he's going to accept the highest bid, which is probably still far below the actual value of the boat. So that is what we are calling a liquidation value. A liquidation value is always far less than what the normal value of that asset is. So now we have to write down our assets to liquidation value. So if we write down an asset, the asset's got a debit balance. So if I want to write it down, I have to credit the asset account. So there's a debit that needs to go somewhere. And what is that somewhere? It's an expense account. An expense account, what does that do to your profitability? It reduces it or it wipes it out. So can you see that a liquidation value financial statement is going to generate a lot of losses? And then over and above those losses, we have to make provision for liquidation costs as well, possible liquidation costs. So that is also going to have a further negative impact on our financial statements. The second thing is the accrual concept. Now, it's very important that you understand that accounting is all based on accrual concept. All transactions are recorded when they occur and not when cash flow takes place. So income is recognized when it's earned and expenses is recognized when it is incurred. Now, what do we mean by that? Let's say in our little example of having a furniture factory. We are going to sell some of our furniture for cash and some we're going to sell on credit. So let's assume we're going to sell furniture on credit to somebody. When do we record the income on that transaction? We record that sales revenue when the guy takes his table and his chair and he walks out of your furniture shop. And we said, well, we have delivered that. He has taken the stuff off our premises. The sales transaction is concluded, and now we're going to recognize the sales revenue. We do not wait until the last cent has been paid for the tables and chairs by the customer before we're going to recognize the sales revenue. So that is what we mean by saying income is recognized when it is earned. Expenses is recognized when it is incurred. Now, what do we mean by that? We have used the internet and the Wi-Fi for our business for this whole month of February. The bill for that usage is only being received on the 2nd of March. We are only going to pay that on the 5th of March. Should we recognize the Wi-Fi and internet expense in February already? The answer is simple, yes, we have to. Why? Because we've already used the service. And when did we use the service? In February. So we've used the service in February. We only make payment in March, but that means we have to make provision for that payment in February already, because that cost belongs to the month of February. So the expense was incurred in February. So the expected future movement of cash is therefore shown in the financial statements. The expected future movement of cash is the amount that the debtor is going to repay me on the tables and chairs that he's purchased from me. The future movement of cash with the internet expenses is when I'm going to pay on the 5th of March my internet and Wi-Fi account. Then we get something that we call fundamental qualitative characteristics, and that has got two main players, the one being relevance, the other one being faithful presentation. Now, relevance here is all about predictive value or confirmatory value. Now, what does that mean? Guys, I bought a delivery vehicle for my business. It has confirmatory value because you can go and expect my delivery vehicle and you can see, yeah, it is a 2021 model of a Kia whatever, and they are currently trading at whatever price. Confirmatory value. I can confirm the value and the existence of the asset. Predictive value. I have bought this vehicle for 400,000 Rand. I'm going to write off this vehicle over a 5-year period on the straight line method. So I'm going to write off an equal amount of depreciation on this vehicle on an annual basis. So 400,000 over a 5-year period gives me a depreciation expense of 80,000 Rand per annum. Predictive. What am I going to write off as depreciation next year? 80,000. What am I going to write off as depreciation the year thereafter? 80,000. So it's got predictive value. The second one is nature and materiality. Now, let's talk about materiality first. Materiality is an item is material when it has an impact on the decision making of the user of financial statements. So if an item is as such that it can affect the decisions that a user can make on the financial statements, then it is material. When an item is material, it has to be disclosed in my set of financial statements very clearly. Now, let's talk about nature. Let's say that we take all our expenses and we draw a pie chart of all our expenses. And when you look at the composition of our expenses, we will see that there's a lot of small little expenses that it's like it makes up about 1% of our total expenses pool. Am I going to list all those thousands of small expenses, which only amounts in total, all of them added together to 1% of total expenses? Am I going to mention each one of them separately? Heaven forbid, no. I'm going to group that all together and I'm going to call that something like a sundry expense. It is so insignificant in value that the nature of that and the materiality of that is such that it will never have an impact on the decision making of any user of financial statements. So therefore I can add it all together and show it as one line item, my statement of profit or loss. Please go to your textbook. They've got very nice reading here on materiality and nature. Make sure that you read that and understand what they're talking about. Faithful presentation. Now guys, faithful presentation is about three things. It's about completeness, neutrality, and free from error. Completeness. I must make sure that all the transaction that was entered into in the current financial period is recorded in the financial statements for that specific period. So it must be everything completed. Neutrality means that my financial statements must be completed free from bias. So I must conduct my transactions and I must record my transactions totally independent, not with somebody else's personal interest in mind. Neutral, free from bias. And then obviously free from error. So my financial statements must be free from error. But now again, link this free from error to nature and materiality. Let's say, for instance, that I have picked up after my financial statements was published for the year, that there was an error made in the financial statements. All of us are human. Humans make errors. That's a fact of life. The nature of that error was as such that it is, let's say that our net asset value of the company, so assets less liabilities of the company, equaled 1 billion rand. This mistake that I've made has an impact of 500 rand on that 1 billion rand. Guys, is that material in its own? No, it isn't. Is that 500 rand going to make any difference to any decision that any user of the financial statements is going to make? No, it's not going to impact anything. Then I can just adjust that thing. I don't have to adjust my previous year's financial statements because the nature of the mistake and the materiality of the mistake is as such that it won't have an impact on the readers of the financial statements. Obviously, the mistake must be adjusted, but I can adjust it now in my current year's financial statements. I don't have to restate my previous year's financial statements. Good. Then you get something that was fundamental qualitative characteristics. We also get enhancing qualitative characteristics of financial statements. Now, you must be able to distinguish between the two. You must be able to talk about the two of them separately. Now, the first one here is comparability. Guys, that's why we use IFRS and IAS, so that we are able to compare two companies' financial results with each other. Because both of them applies IFRS, and in South Africa, all companies have to apply IFRS. Then we know that we can compare their financial results with each other. The next one is verifiability. So we must be able to go and verify the existence of that delivery vehicle that we have bought. We can have a look at it with our own eyes. We can see that, we can verify it. It is there, so there's no problem. Financial statements must be timely. Now, guys, it is better to have a set of financial statements which is 98% correct, but I get it within 3 days after the financial year end, than to have financial statements that is 100% correct and I can only get it 6 months after the financial year end. The longer the time expires after the financial year end, the less value that financial statements possess. And after a couple of months, it is virtually useless. So therefore, it is of extreme importance that financial statements are delivered very timely, as soon as possible after the end of the financial period that it has bearing on. Then understandability. Now you will see, as you're going to go along with your studies in accounting, that financial statements becomes extremely technical. Now, this understandability doesn't mean that a normal guy in the street must be able to understand a set of financial statements, because that is not what we mean. What we mean by understandability is that a person with a reasonable knowledge of accounting must be able to understand the financial statements that we are talking about. Good, so I'm going to carry on with definitions of the elements of financial statements in the next video.